Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. It is the 30th of June, the end of the financial year. If we were sitting here a year ago and I told you you're only going to get 3.3% back on your equity returns on average, you may not be overly happy with that, but that is where the S&P ASX 200 looks to end the financial year. The SIBO 200 today down 0.2%, while the S&P ASX 200 is down by about 0.4% heading into the match off. But as I mentioned, for the financial year, we've seen a return of around 3.3% or 3% there on the S&P ASX 200, the All Ords up by about 2.5%. So not really the best return there, but let's get into the overall themes of the day. I guess we can at least be positive that it was an up year and not a down year. But happy EOFYS for anybody who remembers that ad, end of financial year sale. And of course, certainly it does look like some of the stocks have been on sale today, particularly some of those gold players. We also had the RBA's minutes released today, really showing that hawkish hold that we saw in June. ANZ saying the cash rate in their view will remain at 4.35% for the next year or so, notwithstanding that the minutes really, they say, underscore the board's hawkishness and the risk of a further rate hike. I spoke to TD Securities' Prashant Unaha. He doesn't see a rate cut until early 2028, but is also in that same view that we're likely to see rates on hold at 4.35% for the remainder of 2027. And then diggers down, this is really the weakness that we have been seeing in the materials index. Gold reversing to under $4,000 after the US and Iran agreed to stop the tit-for-tat strikes that have tested this fragile truce, and that has seen quite a bit of weakness in some of these gold players. Let's have a look at the sectors as we head into match off, and Northern Star is off by more than 5%, Newmont down about 2%, Evolution Mining is off by 4%, and that's dragged on the overall materials sector, which is the underperformer. And you've got BHP ending the financial year below $60 at $59.29, Rio Tinto below $172. MinRes, though, had a good session today. Looking at energy stocks, that's where you saw some upside today, particularly with the likes of Karoon, which was one of the top performers on the ASX 200, up almost 6%. In company news, Collins Foods made record revenue for 2026. This was mostly thanks to strong demand for fried chicken. Aussies still flocking to KFC despite cost of living pressures, but tacos fell flat. Collins Food continuing its plan to exit the Taco Bell business in Australia, resulting in a $400,000 loss. Atlas Arteria, well, it was also in the news today. IFM Investors increasing their stake to just over 54% at $5.10. Capricorn Metals received federal environmental approval for its Mount Gibson Gold Project. Deep Yellow agreed to acquire energy resources, and Sims Metal there was under pressure, reshuffling its executive leadership team today. Welcome to the COB now. Our guest, George Boboris from K2 Asset Management. And George, I would say that's a pretty lackluster end to the financial year, but as I mentioned, I guess at least we went higher rather than lower over the last 12 months.
Yes, good afternoon. Yes, you are right. That's a good positive way of looking at it. Silver lining. Add some dividend there, the income unit, depending where you are in your self-managed super fund as well. You can activate that income unit benefit. But the thing to reinforce here is it is a lackluster capital return for the Aussie equity market. It's facing an awful lot of headwinds. We say the following and continue to reinforce that we like exposures on the Australian equity market that are linked to the global cycle and exporters. We believe that, and that's obviously predominantly metals, bulk commodities and energy. We believe over the course of this year and the years ahead, there'll be large M&A opportunities in there, say Santos for energy from the Northern Hemisphere. And I'll always use the example of ADNOC Oil, ADNOC Gas, AA+ rating, Santos BBB-. It's a natural merger that didn't go ahead for whatever reasons because of certain ministers. But that's something that M&A hedging, I think, will work in our market. But the key point is for all your viewers is that this is an important part of why you have global equities. And we always say you should have more exposure to global equities than domestic equities. Most people are positioned for that and that narrative over the past decade, and just to maintain that going forward. Search for global earnings as the hedge for the domestic cycle that's got an awful lot of headwinds for many different reasons.
Yeah, absolutely. A really good point there. Let's talk about the more broad economic picture as well, because we had the RBA minutes out as well. Still somewhat hawkish here. I guess we still do have very much an inflation issue.
Embedded inflation issue before the conflict in Iran. Embedded inflation issue without productivity gains is a bad outcome. So any form of expanding GDP with no productivity gains, it's an overgeneralization. You have some really good economists on your program that reinforce this point, that it's, again, expanding GDP with no productivity growth gets passed through on core inflation rising, staying stubbornly high, which is concerning the RBA. However, the RBA are obviously very pragmatic. They can't be upsetting their employer too much and to keep the treasurer on side. But hawkish talk and a hawkish stance at the bare minimum. Another rate cut this year should be able to, I think, reinforce the messaging that this economy needs some form of reform in the medium to longer term because of what's been happening the past decades not working.
So we're still then, I don't know what happened there. We're still then expecting some rate hikes, from the ECB, potentially the BOJ, the Fed as well, or the Fed 2027, do you think? What's sort of like the outlook?
Yeah. So our view, Fed 2027, they've got enough productivity gains to look through, despite this intense capex growth that's driving these earnings for the chip makers, obviously when you're looking at aggregate earnings. So we believe that the break-evens are a good identifier and a good litmus test that things are okay and in control on the core. Headline inflation will be falling considerably given where energy prices have fallen over the past 3-4 weeks, and that will pass through in the second half of the year. That's why we say the Fed is the 2027 proposition. However, opposite, ECB, Bank of England, and the BOJ tightening September, October, November this year, respectively. I think I got that in the right way around, and maintaining that tightening bias. The ECB obviously been keeping rates artificially low because their biggest economies obviously been in persistent recession over the past 2-3 years. They're slowly trying to come out of that defence spending, but tighter rate hikes, again, ECB, Bank of England and BOJ, and I would put the RBA into that camp, that tighter policy, and kicking that Fed narrative next year sometime, possibly, but this is an earnings-led, robust recovery in the broader US market, and these early preliminary PMIs are continuing to reinforce this resilience in the US economy, and that's coming through in the earnings and hopefully the other sectors where we think value will be in transport and healthcare that's been sold off in the US. So a few little missing links there, but that's what we're trying to see on the outlook for this year.
Yeah, and just picking up on that a little bit, where you see some good value, particularly with that strong earnings per share momentum, that's going to drive some business spending, you would think, as well. So apart from tech, and did you mention healthcare there, what other sort of US sectors do you like at the moment?
Still utilities in the US, still transport's got the opportunity in the US as well. Any opportunity on defence, you got to go a lot to the non-listed space for the defence as well, but anything along those lines. And financials in the US, not financials in Australia because of the overweight to the housing cycle. But they're the things we like about that, and some industrials. There is a bit of a footnote here. So with the AI, it is concentrated, and your show has been reinforcing that's been attracting capital, both equity and debt, at the cost of other sectors. And that's why when you'll see earnings going up, but prices not going up as much in those other sectors. So again, transport, utilities, some industrials. When you're looking at the emerging market, be cognizant when you're looking at those amazing returns in emerging market that has been dominated by AI, up to 40% of that coming out of Taiwan and Korea. That's not really a traditional reflection of how the emerging market is. So just to be cognizant of how you're looking at that index, because AI is also boosting some of those returns in that portfolio of yours.
All right, and what about opportunities in, away from Australia or away from the US as well, particularly when you look at that AI theme? I guess the likes of Taiwan, South Korea look good too.
Yeah, so very concerned with the volatility of that. I mean, at one stage, the KOSPI was up over 100% year to date. That's just phenomenal. But where we see opportunity, notwithstanding what's going on with the KOSPI, what's going on in Taiwan, trying or average into the Nikkei. The Nikkei, we believe, a well-balanced, good index to get into from technology, from some financials, and some high-end manufacturers. But we say the Nikkei is that place to be, at least be neutral, the Nikkei market with those opportunities going forward. Parts of Europe, very concerning with the challenges they've got, but there is some value in there if you play it right with some financials. But definitely would say Japan's the opportunity to move into. And then again, Kospi and Taiwan, I mean, that's all driven by this historical, never to be repeated, capex investment into chip making. It's just been extraordinary.
And maybe Japan looking good with the yen at a 40-year low as well. Can get in some bargains there. George, thanks for joining as always. We'll chat to you soon. George Barboris there from K2 Asset Management. All right, well, getting stock specific again, we talked about Collins Foods, and that was the stock of the day. Nadine spoke to our experts, Francesco de Stratis from Ord Minnett, Rudy Philippek van Dijk from FN Arena.
Suspect, while management is having an online chat with analysts, clearly, I think some of the analysts must have heard something that wasn't quite up to scratch there. The times when junk food, I'm sorry, quick service restaurants,
QASR,
when they were like a no-brainer defensive, I think that's behind us now.
And that good number that you saw just then come out of Europe, I mean, how much of that is part of the acquisition that they made? I think, we're looking at, I think it was 8 KFC stores in Munich, so I don't know what that translates to in revenue, but is that part of the reason why they've seen, what was it, 23% growth at the start of the year? Look, the revenue numbers were good. NPAT was up 13% to 61 million. They're all good numbers, but as Rudy said, analysts are looking forward and not looking at what has happened, but looking at where things are going.
Let's have a look at the leaders and laggards as we round out the day's trade and the financial year. Hyperion X up 7%, Megaport, Electro Optic Systems, Karoon Energy and Neuron also good. Neuron continuing to add to its very impressive gain yesterday on the back of that announcement for its debut drug, close to getting EU approval. They were actually the leaders. These are the laggards here. Minerals 260 down almost 11%. Vault Minerals down 7%. Resolute, Regis and Perseus also lower. In the small end of town, we have Cyprium Metals up more than 11%. Interestingly, quite a few material stocks there, even though they were the laggards in the big end of town. Let's have a look at the laggards though, and still Sunshine Metals off 10%. Synlait Milk also not having a very good day, off by almost 8% there. All right, what are we looking out for tonight? US JOLTS openings expected to edge down to 7.3 million, and also the Conference Board US Consumer Confidence Survey. Tomorrow we get building approvals for May, and we've also got Aristocrat Leisure holding an investor briefing. Let's have a final look at where the local market has ended. Down 0.2% there, while the S&P ASX 200 closed weaker by 45 points or 0.5% to 8,778. And when we look over the last 12 months, let me give you an update. We have been seeing a return of just under 3%, 2.8%, 2.4% return on the All Ordinaries Index. That does it. We'll be back from tomorrow, the new financial year. Have a great evening. We'll see you then.